Well, I'll just start out again. Thanks, JC. So I'm Ruby Ward. I'm a professor at Utah State University in the Department of Applied Economics. Welcome to today's presentation. I thought that it was really timely given the drought situation here in the West. This presentation will be recorded and posted on USU Extension's YouTube channel. And when I get that link, everybody that registered for this webinar, I'll send that out to you. The presentation is given by JC Hobbs. He's an Associate Extension Specialist in the Department of Agriculture Economics at Oklahoma State University. And JC and I are both members of the National Farm Income Tax Extension Committee. And the website that the committee has with our various information about farm tax issues is ruraltax.org, and I posted that to the chat, so you can have a link to that website. And then JC has also written an article that's available on that website, Weather-Related Sales of Livestock. And I've also posted a link to that article, so you can have that as a follow-up resource to the webinar today. And go ahead and put your questions in the Q&A. And Chris Becker said, can anybody hear? And so if you guys can hear, give me a thumbs up or just say yes in the chat. So probably that was in relationship to me having my mute on. So I think that we're probably good now, but if there's any problem, let us know. And there's AJC also wrote another article that's on that website that he'll refer to a little bit later on disaster losses. And so those are a little bit different than weather-related sales of livestock, but he'll go through some of that later, and I'll post that link a little bit later in the website or in the webinar. So with that, I will turn it over to JC. Post your questions in the Q&A. I'll try to monitor both the chat and the Q&A, but sometimes they get lost in the chat. So the Q&A is a good place to post those. Go ahead, JC.
Thanks, Ruby. Well, as Ruby said, we were talking earlier in the month, and we decided that given the drought and how it's continuing and enlarging in the Western US and how many states are now involved, we thought this was probably a timely session to talk about what are the rules for weather-related sales of livestock. So weather-related sales, basically it applies to livestock sold in excess of normal due to a weather-related condition, those being flood or drought or anything that causes a shortage of water or feed. So again, it has to be related to weather. Sometimes we run into situations where some of our supplies burn up with fire. No, we're talking true weather conditions. What it does is allows the taxpayer, the rancher, farmer, postpone recognition of income from those sales proceeds. So when we have to sell animals early in a year that we're planning on selling them, what you end up doing is bunching the income in that tax year. So what the rules allow us to do is spread that out, postpone recognition. There's a couple of different ways, but it basically allows us to avoid bunching of income in one year when we normally would have had that spread over a couple of years, which helps us reduce our tax bite. So our desire in this presentation is to help you understand and be able to discuss the options with your tax advisor prior to your filing of your 2021 tax return. Those will be that filings due April 15th of 2022. So we're just going to give you a heads up of things that you need to be thinking about and looking towards the future. So we have various sources of drought information. FEMA, the Emergency Management Group, those become or considered presidential declarations. Usually the president is involved in those declarations with FEMA. You also have Farm Service Agency, FSA, that's the Secretary of Ag. They have declarations as well. And then if we're drought suffering, the U.S. Drought Monitor has state and national maps showing drought intensity areas. So those are the three sources of drought information that we're going to be using to when we look at what the declarations are, what we can postpone, how we go about doing that. So here's the Secretary of Ag designations. It hasn't been updated. When I looked here recently for May, we should be getting close. I think today is, or tomorrow is when they update that. So when you look at the Secretary of Ag, those declarations in the red are the primary counties. The yellow are the contiguous counties. So the way the rules work, these declarations, if you have animals, or you live in an area that's declared a disaster and have animals that sold due to the drought, if they're raised in either the county or the contiguous county, that's when we have a situation where we can postpone that income. In the Drought Monitor, again, another source of information, and it shows areas where we have no drought to what we consider exceptional drought. And then the intensities of the colors kind of give you an idea of where you sit. So if you're looking at the southern half of Nevada, you'll notice that we've got exceptional drought appearing there, as well as western Utah, and then strung in through Arizona and New Mexico. Extreme drought in the Dakotas, in California. And you'll notice as you start looking across the states, we have areas where it's creeping into a lot of different states, anywhere from the severe to extreme exceptional droughts. Those are what we're looking at. Those designations allow us then to apply the weather-related sales in certain scenarios. So what we have, two different tax treatments. Both of them apply to sales of animals or livestock in excess of normal, that being also our normal or usual business practice, due to any weather-related condition that causes a shortage of feed, water, etc. Now, the first rule, and it applies to any livestock. So it can be calves, it can be poultry, it can be breeding animals, doesn't matter. Now, you'll notice in red, I've included a link to, or just information concerning the Internal Revenue Code and the where you can find it. This is not necessarily to help you, but it would, if you provide this information to your accountant, he knows where to look to find out what the rules, what has to be applied to the tax return. So I've included those as kind of a helpful hint to where to look for in the future. The second situation, it applies to livestock other than poultry held for draft, breeding, or dairy purposes. And this is the 1033E rules. So first one applies to any, second one only applies to draft, dairy, or breeding animals. Again, share those references with your tax advisor and be helpful. Now, when you come to the taxable income that can be generated from these, you've got either ordinary income or capital gain income. The ordinary income basically comes from the sale of calves or young animals, animals raised for resale or purchased for resale, things that we don't take into the breeding herd. If we have animals that we purchased that are breeding animals and we have depreciated those, there's a portion of that sale price that could be recaptured depreciation. That is ordinary income as well. The other side is capital gain income. Now, the difference between ordinary income and capital gain is the fact that ordinary income, we end up with several different tax brackets, tax rates. It's not a preferential rate. We have these marginal rates go up. The capital gains rates are much more favorable to the taxpayer. At the bottom end, it can be as little as 0 tax paid on capital gain up to a maximum of 20%. When you look at ordinary income, it goes up to rates or maximum in around 37%. So if it's capital gain income, that's going to be the sale proceeds from raised breeding animals or sale proceeds from purchased breeding animals when that sale price is more than what we paid for that animal. So there's where we get the difference between capital gain and ordinary income. So capital gain applies to raised breeding livestock. 100% of that sale income is treated as capital gain income. The sale proceeds, if it's purchased, it has to exceed the purchase price. So we'll get into the first one. So here we have the deferral of income for 1 year. Again, remember this applies to any livestock. So you have to show the flood or drought or other condition has to be severe enough to get the taxpayer's area designated as eligible for federal disaster assistance. That's either a presidential declaration or the Secretary of Ag. The Drought Monitor won't get you there. What you have to show is that sale of the animals was related to that weather condition. So that weather condition caused a sale of more animals than normal. So the taxpayer, in order to do this, must use the cash method of accounting. Nationwide, that's going to be about 98% of the farmers use cash method accounting. Therefore, this rule or provision is available. Again, like I said, it applies to any livestock. Draft, dairy, breeding are included in here. So it includes the poultry, calves, anything or resale, plus those draft animals, breeding animals, dairy animals. Again, sold to weather-related condition. And the sale proceeds on those animals sold in excess of normal can be deferred until the next taxable year. But the requirements have to be met. So if we sell the animals in 2021, that's normally would have been sold in 2022, we're going to be able to move that sale amount to 2022 income as long as we meet the following rules. Again, principal business must be farming. What does that mean? All it means is 51% of the income in a normal year comes from the farming business. You have to use a cash method of accounting. You have to be able to show that the animals would have normally been sold in the year following, but due to the drought, we ended up having to sell them early. So we have to be able to show that normally they would have been sold in a later year, but due to the drought, they're sold in this year. So all we're doing is keeping records of how many or our annual sales over like past 3 years, and then compare that to the drought sale year. Then the weather-related condition has to be listed, and it has to have the information applied to the return, filed with the return, so we can make sure the declaration was federal assistance and that weather condition caused the sale of those animals. Now, one thing that's kind of unique, the livestock do not have to be raised or sold in that declared disaster area. Only thing that has to happen is the farmer has to be affected by the weather condition that caused him to sell those animals. A good example of this, let's say that you are operating in the northern part of Arizona and you have animals in New Mexico where there is not a drought yet, but the animals that are in the New Mexico area are of a larger size. They're closer to being ready to market, and you need that pasture for your younger animals. You can sell the animals in New Mexico, move the animals from Arizona onto that better pasture. All you have to be able to do is prove that you sold those animals in the year earlier than what would have been normally done in order to allow this provision to take place. So they don't have to be raised or sold in that disaster area. They just have the weather condition just has to cause the sale. Now you have to have lived in that area, but the animals can be from anywhere on the operation. Another thing that happens, we end up seeing the drought coming on. It's affecting us, but we haven't seen a declaration yet. If we sell those animals prior to the declaration, not a problem. So the sale can take place either before or after an area has been declared eligible. Doesn't matter. It just has to be the same weather-related cause that resulted in those sales. Now the taxpayer's history is what is used. Again, this is the inventory of going back several years, showing what you normally would have sold in a typical year versus the number of animals sold due to the drought. Those are basically sold prematurely. You wouldn't have sold them this year, you would have held them on to next year. So all you're doing is providing a listing or inventory of animals sold by year and for the prior 3 years. Now the sale proceeds on those animals, it's deferred. Basically, it's not reported as income on your 2021 tax return. You're going to show that the deferral, the amount in your worksheets that you send with the return, the income will be showing up on your 2022 tax return. So it's very simple, works very well. and allows us to move that income. So here's an example. We normally cull 20 head of cows annually. Due to drought conditions, we're going to sell 30 of those. So we got 10 more than normal. So we make the election to defer income for 1 year for those 10 additional head of cows. We attach a statement to the return showing that we normally sell 20 head, but due to the conditions of the weather situation, the county was declared a federal disaster area, and we're electing to defer the income from those 10 cows until 2022. Very simple. Now, Ruby mentioned an article that I wrote, a fact sheet on the Rural Tax website. It actually has all the information needed when we make the election, all the items that are necessary to be included with the tax return. So get a copy of that if you're affected. It's very helpful. Now, the second provision. Now, remember the first one, we talked about any animal, livestock, any livestock, including poultry, including draft dairy breeding, etc. That applies to the first provision. The second provision only applies to dairy, draft, or breeding animals where we're going to plan to replace those. The rules say your expectations are that you're going to replace them within a 2-year period. So if the 2021 drought caused the sale of those animals early, we can elect to not report the gain, but we make the decision that we're going to replace those. We have to have them replaced by the end of 2023, so 2 years after the drought sale occurred. This rule does not apply to poultry or calves. It only applies to draft, breeding, or dairy livestock. Now, if the drought persists, in a lot of situations, the drought will go on more than just the 1 year. If it occurs in consecutive years, you'll have up to 4 years to replace those animals. So it can be extended from 2 to 4 if we have a continuation of the drought. All you're looking at is information that comes available from FEMA or Secretary of Ag showing that the drought has continued, and then we'll have an extended period of time to replace those. So it goes from 2 years to 4 years. Again, so if you look at what we've got here, Secretary of Ag declarations, you can see where you are. If you're in the red or even the yellow, then you have the ability to postpone sales of those animals. You don't recognize the gain. You end up having the ability to buy them back at a later date. So if you look at it, many areas in the U.S. going to have 4 years to replace the livestock. Again, drought provisions, some of those areas have been in situation where this is the second, even the third year. You're going to have to go back and look. But when I did, there's certain areas that we've had continuing drought situation. With that, sell the animals in 2021, you've got till 2025 to buy them back. And like I said, the Secretary of Treasury, they can further extend that if the drought persists for more than 3 years. I've got some places in the U.S., particularly in Oklahoma, where the drought has gone on for about 8 years or more. So we just keep kicking the can down the road. We've got 3 more years from the time that the drought ends to buy the animals back. So how does this work? We've got draft, breeding, or dairy animals. Doesn't matter how old they are or how long they've been held in your operation. In other words, if you've got heifers that you intend to breed, but you run out of pasture, run out of water, you need to sell those. Even though they were never brought into the breeding herd, their intent was to breed them. Consequently, they get this tax treatment where we can defer the sale income and elect to buy them back. The gain realized from the sale, basically the sale proceeds, then we use that to purchase replacement livestock within that time period. Now, there's no rules that state you have to put that money in the bank and wait till you can buy those animals back. If you're needing money to buy feed, etc., right now, there's no rules that say you can't do that. The issue is when it comes time to buy back those animals, you'll have to either borrow the money or have the money set aside so that you can buy the replacements and get them into the herd. There are also requirement that the animals that you're going to replace those sold with have to be used for the same purpose. In other words, if you're buying or selling dairy animals, you have to buy back dairy animals. If you're have breeding animals, so breeding livestock, we're using for beef, they have to be beef animals, sheep, etc. So they have to be used for the same purpose as those that were sold.
JC, we have a question regarding section 1033E. How about a situation, instead of buying animals back, we just retain more of our heifers in the herd as replacement? Do they have to be purchased or can they be retained?
They have to be purchased. We're going to have to use that income. If you don't expect to buy back, then you would want to use the 451G rules, where you go ahead and postpone the sale proceeds until next year and then bring animals in from your own herd. But you have to buy them back in order to get the 1033 benefit. So then, what are the drought conditions? Now we're looking at the drought monitor, so that you can use the presidential declaration also gets us there. But if we're in an area that we experience extreme, exceptional, severe drought, and that replacement period can then be extended. So what you're looking for is whether or not your county or your area has qualified in those upper 3 levels of drought situation. Now, the IRS posts annually, every September, a list of counties by state that qualifies for the 1033E rules. So whether or not you keep the drought monitor, the IRS does publish that. It comes out every September, and it lists every county in the US that has experienced exceptional, extreme, or severe drought situations. Now, the applicable region, same thing as what we saw with the Secretary of Ag information. It's that county or a contiguous county to that particular county where the rules apply. So your county doesn't have to be directly at the exceptional, extreme, or severe. If your county touches the county that receives that declaration, then you qualify there as well. Also, no requirement that the weather-related condition cause the area to be declared a disaster area by the federal government. So, like I said, the drought monitor, the IRS information is all you need. You don't have to have also the declaration from FEMA or Secretary of Ag. A lot of times those go hand in hand, but they don't have to. So all you need to show that weather-related condition caused the sale of more animals than would have normally been sold under normal or usual business practices. And again, to make the election, just show that the weather-related condition existed, how your computation of the main amount of gain realized. So basically the sale price, less any depreciation taken, that's the gain. That's the amount you're going to buy back. How many of different animals, kinds that were sold, for example, cows versus bulls, the number of and kind of livestock that would have normally been sold in a normal business year under normal practices. And here's an example of how that works. We normally sell cull cows 30 head annually. Due to the drought conditions of 2021, we're going to sell 45, so 15 more than normal. You elect to defer that in recognition of income, attach the statement to the return, indicating you're going to be replacing those animals that were sold in excess of normal. Then we sell the animals, those 15 heads sold for $50,000. We must buy back at least $50,000 of replacement heifers or cows within that time period. We don't have to buy back 15 head, just $50,000 worth. Because what we normally notice in the times of drought or times that we have to sell animals is that we're experiencing depressed prices because a lot of our neighbors are having to sell animals. But when we get ready to buy them back, everybody's wanting to buy animals. So the requirement is the dollar amount, not the number of head. So what happens when we buy those animals back and we spend less than the $50,000 for replacements? Well, we get the pleasure of then amending the 2021 tax return. We're going to pay the additional tax due. If we spend more than the $50,000 for replacements, we get to take advantage of the fact that anything above the $50,000 we get to depreciate that amount on future tax returns. If we spend exactly $50,000 on those animals, nothing happens. We actually broke even. We did well. So by replacing those cows, 4 years to buy them back, 2 years. If we just have 1 year of drought, you have to replace as many dollars as were sold, and then all the gain on the new cows, or the cows that were sold, gets postponed. Now the repurchase can be staggered. We don't have to buy them back all in one time. And if we have a 4-year replacement period, we can repurchase those in any particular year. We just keep track of the amount of dollars spent, and we kind of keep track of the tax basis of those animals as well. Your accountant will know how to do this. Those are the rules that comes when we purchase those replacements to rebuild our herd. So additional information needed. Take to your accountant, basically the gross sale income from the cows. If there's remaining tax basis. So what does that mean? Well, if it's a raised cow, that basis is typically zero. I find very few situations where a raised cow basis is not zero. The reason for that, as we raise this heifer to go into the herd, we take and we deduct all the expenses of raising that animal each year as the animal grows. When we put her into the cow herd, her basis is zero because we've deducted all the costs of raising her. If we buy a cow or we buy a replacement heifer, our basis in that is the purchase price. And then we get to depreciate a piece of that over a period of time that we have her in the herd. So the basis is the purchase price less any depreciation that has been taken. And then we allocate the cost of the new cows with the tax basis from the old, so that we get an idea of what our value is for the new cows, the amount that we can either depreciate or the amount that we hold them on the books for capital gain treatment. So here's what we need to look at tax basis: cost of the new animals, sale value of the old animals that were sold in excess of normal, the tax basis in those cows that were sold in excess of normal, and then the total number of new cows purchased. So like I said, it doesn't have to be head for head. We're looking at dollar for dollar. And then we just make the allocation among the number we bought back. So we start looking at this. Which option do you select? Well, the obvious one was back to that question. If I want to replace with my own cows that I raise, then you're going to want to take the 451G where you just postpone that income for 1 year. If we're going to buy the animals back, then it becomes a little more challenging. Then you want to look at the 1033E. A lot of the decision of which one to pick is not an easy answer. You'll need to sit down with your tax preparer, your tax advisor. You'll look at your economic situation, your tax situation. What are your goals? Are your goals basically we want to build back the herd to exactly where it was, or do we want to streamline some things? Now, one thing to consider, if you make the 451G election and later decide you want to replace them, you can make the change. You can elect to change from a 451G to a 1033E. So in other words, you can change from reporting the income next year to reporting or postponing it and applying that to the animals we buy back. But we cannot reverse the other way. If we make the election to buy them back, we can't then change our mind and count them as income in the year we would have deferred them to. So keep in mind, look at it very closely. Additional things to consider include whether you're going to scale back the business, whether you're going to use the money from the cattle sales to get into or expand into another enterprise. If we're going to get fully back in the cow-calf enterprise, that'll help make the decision as well. If you're looking at getting out of business and help somebody get into the business, in other words, transition the farm from your ownership to somebody else, maybe an heir, or retire and never look back. So those are some things you've got to look at. Also, current and future income and expenses, potential tax rate changes. If the taxes are going to be less this year than next year or a few years down the road, it might be wise to go ahead and pay the tax by reporting it as a 451G rule. In other words, you're going to pay the tax the following year versus kicking the can down the road by buying back replacements. Again, your tax preparer can help you make that decision. So go to the ruletax.org. There's some tax topics. Weather-related sales information is there. What you want to do is take that information to your tax preparer, help you look through the tax consequences of each alternative, whether we look at the involuntary conversion rules or the deferral of income for 1 year. And everybody's tax situation is different, and everybody's decision will be different as to which way or which is best and what we need to be doing for tax planning. So talk to your tax advisor. There's some other things that could impact your decision of the deferral for 1 year or buying back. Looking at non-farm versus farm income, your tax brackets, whether or not you can apply income averaging to your business. Basically what this does is you take the income in the high year and move it back to years of lower income and get a tax refund. Income averaging is something to consider. If you've got disaster payments coming from USDA, those proceeds can impact what's going on and how you want to treat this as well. Crop insurance proceeds. If you've got net operating losses, those net operating losses carried forward can also impact your decision of which one of these two rules to apply. So again, it's important to talk to your tax advisor, look at all the things that are or fit your particular situation, and then begin to make the decision of which one is best for you. So with that, Ruby, we got any more questions before we go to the next piece?
No, so far we haven't had any other questions come in. I just also typed it into the chat. If you have any more questions, please type those in and then we'll get them answered. And I also reposted the link to the article that JC was referring to. And we did get a question. Will we get the slides emailed to them? We'll probably end up, I'll talk to JC, but we'll probably post the slides, and the recording of the website or the webinar will be on Utah State University Extension's YouTube channel, and everybody that registered for that, I'll send you out all the information for that in an email when it gets posted. And then another comment, it's probably good to keep in mind that after selling breeding livestock, calf sales will probably be lower for a few years, which might favor the 451G option.
That's correct. Good point.
Okay, and so I asked JC to include some information on disaster losses, because a lot of times we confuse those with weather-related sales or weather-related issues. And so he's going to go into that, and he's got an article on that too. And I'm going to go ahead and post that in the chat, and I will let him continue.
This next section, we're going to talk about things that may be coming down the pike. We're talking about disaster losses and the tax rules that apply to those. So a disaster loss is typically what we consider a casualty loss. So it's something that pops up sudden, it's unexpected, it's often an unusual event, not gradual deterioration of the asset. So that's theft losses, vehicle equipment accidents, fire, not willfully set by the taxpayer. So we're not doing a controlled burn, but something happens. Let's say we're baling hay in the field and a bearing gets hot, sets the field on fire. That was not a willful situation. So that fire is a disaster. Flood, tornadoes, earthquakes, lightning, freezes, terrorist attacks, vandalism, volcanic eruptions, or even if a government ordered demolition or relocation. So we look at those pieces I've listed there. Those are what's in the tax code that looks at a casualty situation And those have become what we look at for deductible losses. So let's use the assumption that we've got a fire that goes through the farm and it burns up various pieces of equipment, buildings, fences, etc. What you're looking at is the condition of the property that was destroyed or damaged prior to the event and immediately after the event. So you're looking at fences before the fire went through and what they looked like afterwards. Same thing with a building. What did the building look like before? What did it look like after? Now, depending upon the types of property, there are different tax rules that do apply. For example, when we look at property, we have really two types: business use property and personal use property. Business items are on the farm being used in that particular business. Personal use property not applied to the business. The personal home, personal car, items in the home, your antiques, your treasures, etc. So the business property, you're looking at what you produce, what you raise, any assets, depreciable assets or non-depreciable assets that are used in the farm business. And then some various other things that can apply if we have business use property and if for a cost share that is applicable to the replacing or rebuilding, that impacts what is deductible. So if it's raised versus purchased versus if there's cost share, we have to look at all those pieces, and all of them have an impact on the amount of deductible business loss. If an asset is insured, there are situations where we can have a casualty gain that actually becomes taxable versus a casualty loss. And what you're looking at is, did the insurance proceeds pay more than what the actual value of the asset was? Some situations that does occur, hence we get a casualty gain. So here's what the tax rules that do apply. Now, as Ruby mentioned, this article that I wrote, there's about a dozen examples in this thing. You'll want to look at it because we break down all kinds of property. But when you've got business use assets, you have to look at each particular item that was damaged or destroyed. You've got to look at the tax basis that exists at the time that it was damaged or destroyed. So if it's a positive tax basis, one thing to look at there is the fact that you may have a loss. If there is no basis, let's say you've depreciated that tractor down to zero, it's destroyed, it wasn't insured, you've already taken all the loss of that use of that asset as depreciation. You do not get to take an additional amount due to the fact that it burned. If it was insured and you get insurance proceeds, again, you look at the tax basis, insurance proceeds, and you could possibly have a gain. If you take that insurance proceeds and replace the asset, if we spend more than what was there for business use property, so we spend more than what the proceeds were, we'll have additional depreciation allowed on that piece of property, that asset. So we buy a new tractor with the insurance proceeds. The insurance gives us $30,000. We buy a $50,000 tractor. We have $20,000 of depreciable basis that exists. So the casualty gain, look at that again, comes back, electing to replace the asset. We can avoid having to pay tax on that. If it's a casualty loss, you do get a deduction of that on the return. So those are what you got to look at for business use assets. Now, personal use property, again, you look at each item. You've got to look at whether it was insured or not. We may have our home that's insured, but we may not have the content insured. The home, if it's insured, we're probably going to get it replaced. If we don't spend as much money on the new home as we had on the old, even though the insurance proceeds were large enough to pay for all of it, the insurance proceeds, since it was personal use property, is not taxable. But if we spend more, we don't get the depreciation item either. So Personal use property a lot of times doesn't result in any casualty gain. It may or may not allow us to have a casualty loss. Here comes the rubs on this and why we may not have a loss on that, deductible loss. Your itemized deduction rules, it sets limits as the amount that you can take. So we're looking at a limit of $100 for each event, and to then reduce that total amount by 10% of your adjusted gross income. So all of a sudden you can see quickly that you may or may not have a good or deductible itemized deduction due to a casualty loss by simply the pieces of the rules that require you to make the adjustment for each event, and then you have to make the adjustment based upon 10% of adjusted gross income. Also, some other information that's contained in this article. Like I said, there's 12 examples looking at 12 different kinds of property, situations where we've got cost sharing to replace, where we've got insured property, non-insured property from the standpoint of the business. And then there's about 3 or 4 examples that look at just personal property, insured, uninsured, what happens if we have a gain, et cetera. So in that article talks about how do you reconstruct records. So fire goes through, burns the house, burns all of your records. There are, this IRS publication 2194 walks you through places where you can go find information. For example, the county clerk's office will have values. Your abstracts can have values. There also, your tax return over the period of years can list all the assets on the farm, provide some list of what the assets were in the home. Your insurance that you have with an insurance company, they may have asked you to put together a list of items. Also, your historical information. If there's anywhere you've got some past history, that is very helpful. So reconstructing records, they provide some information of how to do this and what's necessary. How do you document your losses? Photographs. Photograph what happened. Take pictures of the tractors, combines, livestock that passed, were killed. That helps them know how much was there. Your inventories, feed inventory, etc. Tax records. All those things are great for documenting losses. Again, if you look at this article, it lists out even more than that. But those are some of the highlights of what you need in order to come back, prove what you lost due to this fire, flood, or theft. Now again, realtax.org, disaster losses and related tax rules. Great article, about 10 pages worth of good stuff. Examples, different types of property, how you reconstruct your records. It also gives a list of IRS publications and other resources that can be useful to you in putting together or rebuilding, proving what you lost, etc. Now, what I've noticed looking at the disaster declarations in the various states, there's not a lot that have been listed yet. If fire comes through, burns your an area, it may take a few weeks before that declaration gets approved. Well, don't wait until it gets approved. Go ahead and start collecting the information. That can always help you. If you have a disaster declaration, it increases the odds that you're going to have deductible losses. Your personal property losses will often kick in, and you'll have some additional loss that you can deduct. Take this information, all of your information that you've got. Be sure to consult with your tax advisor and do this as quickly after the disaster or the casualty has occurred as possible. They can help you get started, get your documentation in order, make sure that everything's in place, so that because it's going to be quite some time between now and the end of the year. And by the time you get ready to do your taxes, a lot of this information can be lost, or items that are necessary will be forgotten to list. So with that, here's my contact information. You have specific questions, feel free to email me. Email works much better than calling me on the phone. So send me an email and I'll get back to you. So with that, Ruby, that pretty much wraps things up. Let's talk questions.
All right. If you have questions, then please just put those into the chat or Q&A. If you'd like to ask your question orally, then raise your hand and I can unmute you and allow you to ask your question. So, and again, this recording will be published to Utah State University Extension's YouTube channel. And everybody that registered for the webinar, I will email that information out when the recording becomes available. And I've got links in the chat to the articles that JC was referring to and ruraltax.org. So you can go there for more information. So
Ruby, thank you for allowing me the opportunity to present today.
I'm just glad that you're willing to do it, JC. I really think that this is a good one to have on a recording because of all these things that have been going on with the drought. And I think it's just going to intensify as we go throughout the summer. And so this will allow people to at least know the tax advantages for the various options that they have. And that can help with their decision making as they go through their production year.
And if you'd like a full-blown program on the disaster or casualty losses due to fire or floods, etc., we can redesign this thing and just do a session just covering those specific topics.
And if you want that, go ahead and indicate that in the chat so that we'll know if that's something that you're wanting a future webinar on that topic. And I am not seeing any questions. So again, the information, we'll have this recording available. I'll send that out to everybody that registered. And then if you want any future webinars on something more extensive on the disaster losses, including fires, then let me know that. And I think that is oh, we do have a question. Let me pull that up. So they're not, can you also email the web links? Yes, I will go ahead and, so the question is, I'm not sure chat can be viewed in the recorded webinar. Can you also email the web links? I will take, I will save that chat and then pull out all those links and have them with the explanations of where they're at. And I can email that out when I email out the information on the YouTube recording. Yes.